Hey everyone, Couch Investor back to another video for today. So in today's video, let's talk about Amazon. Lots of noise and news surrounding the company lately. Another 18,000 employees are being laid off, downgrade by UBS. And in this video, I want to show you why this isn't really something you should worry about. Why is that? Well, because 18,000 employees in the grand scheme of things for Amazon is not much. And a downgrade, well, the price target is still much higher than the price it is today. And I'll show you the historical graph of the price targets that analysts have given Amazon as the price of the stock goes down. Now, I'm also going to talk about how Amazon used to perform during a recession, more specifically during 2008, 2009, and why maybe history might repeat itself. So if you're interested in that, hit that thumbs up button and subscribe if you have not. And if you want to support me and this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to full.com/couchinvestor. So first things first, Amazon to axe 18,000 workers as more US tech firms cut jobs. Amazon boss blames economic uncertainty and recent rapid hiring while Salesforce cuts 8,000 roles, almost 1 in 10 staff. Now remember, we're seeing a high inflationary market, economic uncertainty, the Fed still doesn't know what the heck is going on, so expect more headlines like this. Now, of course, 80,000 people losing their jobs is not good news. From a company standpoint, this means fewer expenses. But let's be honest, for Amazon, this doesn't really move the needle much. Why is that? Because if we go and look at their latest report, you can see here employees full-time and part-time exclude contractors and temporary personnel. Right now, it sits at 1.5 million. This was Q1 2021, 1.33 million. Okay, remember those numbers. Right now, 1.54 million employees. Let's go back a bit more. This here, the 840,000, this is Q1 2020. So from Q1 2020 to the last quarter they reported earnings, they grew their employee base by 700,000. I'll repeat myself. Q1 2020, Q3 2022, they went from 840,000 employees to over 1.5 million employees. So 18,000, not really going to move the needle much. And if we're being honest, we're probably going to see this happen with Alphabet as well. They also have hired more and more employees each and every quarter. We've covered that in the past as well. So I do expect Alphabet to come out with the same headline. They will be laying off probably a couple of thousand employees as well. Now, for the overall economy, this is not a good sign, especially not if the Fed does tend to increase rates even more and more people are unemployed. Well, this is bad. Bad, very bad. Now, with regards to the price targets, so this is Amazon. As you can see, the black line is the average price target, blue line is the stock price, green is the high, and red is the low when it comes to the price target estimates. So you can clearly see a pattern here, right? The average goes down as the stock price goes down. As they say, price drives sentiment. Because let's say we're here, Amazon trades at $164 or so. Fine, when you have your price target of $300, $350, you don't really care much. But if you go and you look at the price target right now of $350 and the price of the stock is $83, well, you might look like a fool, even though your model is completely fine, just the market doing its thing. But usually what happens is then analysts, just to be in the mix of things, suddenly change a couple of numbers in their model to better fit the narrative today. Because remember, at the end, a DCF, the outcome, you decide the outcome. If you want a higher price target, if you want a lower price target, and then it's just a matter of how you justify those numbers. Now, on the positive thing, the target percentage difference between the price that is today and the average is an upside of 67%. So quite nice. Now, a quick overlook of the state of Amazon right now. You might remember this from my previous video about why I sold Shopify and bought Amazon instead. So, like I said, last 12 months revenue over $500 billion. Free cash flow in the last 12 months is negative. Hopefully we've bottomed out and making our way up, especially with those cost cuts. Let's see what happens there. Return on equity has been trending lower. We're still positive at 8.78%. Gross profit margin is going up 43%. Then PE to growth, we're at 2.41 in the next 12 months. Fine. But then from an EV to EBITDA standpoint, in the next 12 months, we're at 12.4x. That's completely okay with me. Between 10 and 15, that's usually the sweet spot. And now I do want to touch on the aspect of how will Amazon as a business perform during a recession? Because, well, 2023, if you missed it, is supposed to be the recession year. So how is Amazon as a business going to go through it? So for that, let's have a little history class. So I've pulled up the graph here. This was Amazon stock. I'm going to talk about the business in just a bit, but just for the sake of the intro. So Amazon stock crashed 57% from August 2008 until November 2008. So quite fast. Since then, still 2008 November, up until late 2009, the stock soared close to 300%. Remember, this is supposed to be a recession, right? This is supposed to be a recession. So what exactly happened there? So I've pulled up an old earnings report, as you can see here, 2009, 8, 7, 6, and 5. Net sales, regardless of the financial crisis, has increased each and every year. Income from operation, same thing there. Net income has also increased each and every year.
Because the stock is not the company, and the company is not the stock.
So, as Jeff Bezos said, price can do one thing, company can do another. And in his case, also in the dot-com bubble crash, in his case, the company's metric, the fundamentals, kept doing better and better. Now, how come this happened in 2008, 2009? Wasn't that the financial crisis? Why would people shop on Amazon? Well, the question is, why wouldn't people shop on Amazon? Saves them time and saves them money. Usually things on Amazon are cheaper. You don't have to take the car. You don't have to stand in line, waste time, probably pay even more because you're going to the store. Just order this online. And today, no brainer, right? So maybe if we go in a high recession, soft landing, I don't know, yes, no. Regardless, shopping on Amazon just makes more sense, especially if you have Prime. It gets delivered as soon as possible. Now, of course, Amazon today is not the Amazon of 2008. Amazon today has AWS, which, of course, will maybe see some slowdown there, but it also has a huge and growing advertising business. It has a subscription services. It has third-party seller services. So the Amazon today, in my eyes, is much stronger as a company than in 2008. And if in 2008 it performed so well, why should I doubt it right now? Of course, they overhired in the last 2 years, so cost cuts are a given. But to me, betting against Amazon is just a losing bet. And now last thing, and that's regards with the lowering of the price target at UBS from 165 to 125. So he keeps a buy rating on the shares as well. So following a round of cloud checks on the company's AWS business, the analyst is reducing his growth estimates to 21% in Q4. I think it's down from 27% in Q3. So 21% for Q4, 18.4% in 2023, and 19.3% in 2024. Basically, he sees it reaccelerating in 2024. The analyst adds that his AWS enterprise value to expected revenue multiple is also being cut to 7 times from 10 times, noting that consensus estimates for the segment are meaningfully too high. And yes, maybe that's because, well, there was hype around that business. We've seen it grow constantly over 30%. So maybe right now a re-rating makes sense. Now, if AWS gets a re-rating, then Azure and Google Cloud will probably get those as well. So overall, those are my thoughts for Amazon right now. Obviously, do share your opinion down in the comments below. And if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.